Hello, my name is Max. I'm the founder of Finimize, and I would like to welcome all of you to the Finimize Modern Investor Summit. It is the largest virtual and in-person retail investor event of the year. And as we all know, we're experiencing continued market turbulence. It's more crucial than ever to cut through the noise, speak to the investors who've been through these economic cycles before, and who can share their experience and views with us so that we can learn and make more informed decisions. And today, I have the privilege of speaking to one of the most well-known investors in the world, Cathie Wood. She is the founding CEO and CIO of ARK Invest, an investment management firm that is best known for its focus and on innovation and its open research ecosystem. The firm currently manages $13 billion in assets. If we got the right data from Bloomberg, perhaps Cathie can confirm that number. So first of all, welcome, Cathie. Great to have you.
Oh, thank you, Max. I'm delighted to be here. Thank you for inviting me. And in terms of AUM, we are at about somewhere between 22 and 24 billion.
Okay, fantastic. So I think we have a lot to talk about. So I'd love to jump in, but before we do so, just for our listeners and viewers, this content is not investment advice. It's for informational and educational purposes only. So please bear that in mind. And with that, let's kick it off. So let's start with what's on everybody's mind, the current market downturn. Ray Dalio just came out and said that we certainly have not seen the bottom yet. He's expecting more declines. Curious, Cathie, how do you read where we are in the cycle right now? How long do you think it will still take? And importantly, how do you think about adjusting your investing strategy, if at all?
Okay, in terms of where we are, we're in this downturn primarily because of inflation and interest rates and fears about how long it's going to take the Fed and other central banks to get inflation in particular under control. Now, there are two ways of looking at this inflation. One, which it seems the Fed and the ECB are using, is this is a lot like the 70s. It was inflation that became embedded, and the Fed had to really strangle it out of the system. So that's the way they're going about it. The other way of looking at it is that this inflation happened because of a major supply shock. Started with COVID. I never would have dreamed supply chain issues would last for 2+ years, but they have. And then, of course, Russia invaded Ukraine. And so we've had that supply chain issue, that pricing issue. So if this is a supply shock and was really a 15-month problem, that's how long it took the Fed to really turn around and say, wait a minute. It is not a 15-year problem. If you look at the 70s inflation, it started, at least in the United States, because of the Vietnam War, 1964, and the Great Society programs that President Johnson put in place, all kinds of new social programs, also 1964. We went off the gold exchange standard in 1971. Oil prices quadrupled, and all hell broke loose for the rest of the decade. We got to double-digit inflation, and it was really hard to pound it out of the system. Federal Reserve Chairman Volcker gets credit for it, and he was very brave and courageous to tackle it the way he did. I think Chairman Powell here in the United States thinks that he is the reincarnation of Chairman Volcker. And I think that's a mistake, because this is not a 15-year problem. It's a 15-month problem that the Fed started tackling, and we were already beginning to see deflation. If you look at the commodity complex, so this is upstream inflation, that we're seeing commodity prices down 30, 40, 80% some of the freight rates, which measures supply chain issues, those have come crashing down 80%. That's in the pipeline, and it's going to get into the PPI and the CPI at some point. The second thing that's going on is because we have so many purchasing managers were afraid they wouldn't get goods. They double and triple ordered. And now the goods are coming and whoa, we don't need that much. And oh, by the way, the consumer is saying, I don't think I want to buy that much anymore either. And so massive inventory overhang. So pricing downstream is coming down. We're hearing about 50% plus discounts here in the United States as companies try and clear. So what we think started this off, and for us, it was February of 21, when people were getting vaccinated, going back to work, the fears of inflation and interest rates started, and our strategy peaked out. That was February of 21. Most strategies didn't peak out till earlier this year. Ours was a year before. And of course, now, if we're right, we're going to start seeing deflation on a month-to-month basis. And we wouldn't be surprised to see CPI negative year over year at some point next year. If we're right, what has happened during the last 2 years is going to flip. And we think the market will flip back to a preference for growth stocks and our innovation strategy.
And so just very quickly, if I can double click on the statement around the timeline, you say 15 months and not 15 years, whether it ends up being 18 or 20 months. We're talking about a compressed timeline here. What makes you so confident that is the case? Because as you said, there were two key drivers of this. One was COVID, and the other one is obviously the war in Ukraine. And COVID, I think we can all agree that's probably, we've seen the peak of it. It's here to stay to a certain extent. But if we look at the second factor, the war in Ukraine, nobody really has a clear understanding of when that is going to end. And are you not concerned that is going to continue to drive inflation from an energy cost point of view?
Right. Well, even energy prices, if we look at per barrel, they peaked at 130 in March, which is right after the invasion. And today I see they're down to, I think this is West Texas Intermediate. So they're down to $77. I know that Brent is a little higher than that. But think about that. We've almost cut oil prices in half from their peak. Now, why is this happening? Well, it appears that the fear of being short energy in the middle of winter caused an inventory build that is doing the job. It looks like the storage is pretty full, and number one. And number two, there are a lot of workarounds now that are taking place. U.S. is sending a lot of LNG, liquefied natural gas, into Europe. And so Europe is not so dependent anymore on Russia, at least not nearly as much as it was. And it will continue to find workarounds, of course. So our confidence actually has increased for that reason, right? The war is still going on and it is terrible. But in terms of the impact on the global economy, we're seeing workarounds for both energy and food. So there's nothing like the price signal, soaring prices for food and energy to invite new supply in. So you bet the farmers here in the United States are going full out, knowing that the breadbasket of Europe has been harmed quite significantly. So
if I could just jump in there, so are you saying that because it is such a compressed timeline, you do not see any necessity to change your investment strategy and you're sticking to your guns, you have strong conviction and you're not making any adjustments, or are you making adjustments?
So there are two topics here. First, just finishing up on inflation. The two pushbacks we get are rent and wages. Here in the United States, rental income growth is decelerating dramatically. And I think that inflation rate has been cut nearly in half as well. It's still there, but it's coming down pretty dramatically. And wages never hit anything like the inflation we saw, and those growth rates are coming down as well. So that's inflation, and basically summarizing, we think the surprises during the next year are going to be on the low side of expectations. So that's the first thing. In terms of our strategy, what have we done during this nearly 2-year period when market forces have been against our strategy? Well, we do what we have always done, and we concentrate our portfolios towards our highest conviction names. Now, in our flagship strategy, which in the ETF is ARKK, we've gone from roughly 58 names to 32 names in the last 2 years. One of the kinds of stocks we let go were the Chinese stocks. And our conviction was waning as we saw that government coming down hard on Ant Financial and Alibaba, therefore, on gaming, on education, and on crypto exchanges and mining. So our confidence that China was going to be one of the big leaders in innovation was damaged. And so we consolidated out of those names. So that's good because they've not been good stocks, but our names haven't been good either. So we we'll wait to see, longer term what plays out. And as you probably know, our investment time horizon is 5 years. So what have we done in concentrating? We've taken the names out where we have some doubt. I just mentioned China. Mm-hmm. We're concerned about what common prosperity means for profit margins and the incentive of business leaders to scale dramatically because the government doesn't want anyone challenging its power. So we scaled out of those. We scaled out of companies where there have been significant management changes or we're somewhat worried about competitive dynamics. And we scaled into the names in which we have our highest conviction. We have a 6-point scoring system. So we do our top-down research, our bottom-up research, and then the overlay is a 6-point scoring system, including, management, meaning people and culture. Do we have visionary management and a devoted, very loyal workforce in these companies? Moats and barriers to entry, product and service leadership, so market share statistics. We have execution. Are they spending enough in R&D? Are they spending it in the right places? We have valuation. That one gets a lot of questions. High valuations now because our companies are sacrificing short-term profitability for long-term success in these innovation platforms. And then finally, thesis risk. And so using those 6 scores, we consolidated towards the highest scoring names. Mm-hmm. And we've done a white paper, it's on our website, showing the impact of our concentration strategies over the last 8 years since we started ARK. And the outcome is usually very successful in terms of our highest conviction names outperforming the markets significantly.
And are you at all concerned around so if you are correct and the timeline is in fact in the grand scheme of things a fairly short one, interest rates don't look like they're going to go down anytime soon. At the same time, you're seeing very dramatic changes in strategies, for example, when it comes to hiring in some of the most innovative companies in the world, hiring freezes, letting go of tens of thousands of people. This would suggest that they have a fairly bleak outlook on where things are heading, which would be contradicting the compressed timeline that you're referencing. So is that something that you're concerned about, both in terms of how some of these innovative companies are positioning themselves for what seems like a longer term downturn, and secondly, interest rates that seem to be only heading upwards?
Okay, so two things there. One, the layoffs that we're seeing um, are in companies that we might say used to be considered the disruptors, like meta platforms, formerly Facebook, Netflix. They were disrupting the media world, the advertising world dramatically, and they have been for years. But guess what? TikTok came along and is taking all the oxygen out of the room, meaning real competition for mind share, the consumer's mind share. So the formerly disruptors are now being disrupted. We didn't own those names, certainly not in our flagship strategy. In some of our very specialized strategies, perhaps we did. But we didn't in the flagship for exactly that reason. We saw that disruption happening. And yet, very interestingly, meta platforms, Netflix, the FANGs generally, are at the top of most growth portfolios, and especially large cap growth portfolios. We are highly differentiated that way. We are looking for the new disruptors. And the reason they may be putting on hiring freezes is not because they're being disrupted. It's because they're investing so aggressively and the market's so focused on cash flow and cash on the balance sheet that they are reining in some of their growth programs in the short term. But they are the disruptors. So that's the distinction I would make.
Okay, understood. And in terms of the interest rates?
In terms of interest rates, if we're right on inflation, then we think the first thing that will happen is the Fed and other central banks will pivot. The Fed will pivot first because we have an extra force fighting inflation. It's called the strong dollar. And the dollar's been extremely strong, up 25% in the last year or so. And that's a powerful anti-inflationary force. And we think the Fed will first change its rhetoric, and the market will rally just on a change in rhetoric. And then we think it will actually start cutting interest rates at some point next year. We will be in a recession. We do believe we've been in a recession. Yeah. We see the inventories being disgorged within the next year, and the Fed will be facing falling prices. So we think it will ease, and I believe other central banks will follow. China probably started. And if you look at some of the central bank actions of late, whereas they were following the Fed, now they're pulling away a little bit. The Bank of England had to pull away because of the liability-driven investing excesses and margin calls and so forth. Their near Lehman moment, as they would say. So they've had to pull away. We saw Australia raising its interest rates 25 basis points instead of the 50 to 75 basis points. China is saying it's going to ease. And one of the other reasons they're changing their spots is they have certain limits in mind for their own currencies in terms of how much will they let them depreciate. Both Bank of China and the PBOC and the Bank of Japan have effectively said, we are going to intervene so that our currencies don't depreciate that much more. And what that means is they are selling dollars and buying back their own currencies. So they're actually adding to dollar liquidity, an effective easing out there, not starting with the Fed, but starting with other central banks.
And if you look back, so you obviously have a lot of conviction in the theses that you put out there, and we'll get to the research process and how you come up with these. Curious, if you look back, there's today, I'm sure you're aware, there's a lot of people who are critical of the performance. They point out the flagship ETF went from 28 billion down to 8 billion. That's a statistic that's quoted all over. So it's been discussed a lot, but I'm curious. Number one, what would you say to these people? What have they gotten wrong? And what are they not seeing that you're seeing? And then if you had to look back, at the end of the day, investors are humans. We try to obviously be as automatic or automated as possible, use as much data as possible, but there is always a judgment call. Curious if you look back at the last 12 to 18 months, have you made any mistakes, any regrets, anything that you would have wished in hindsight, obviously on hindsight only, that you would have done differently?
Sure. So what I would say about the depreciation or the down round, massive down round here, is that has been performance. It is true. What I think has surprised a lot of people, especially in our business, is how well we've retained our assets. Last year, huge inflows. They were beginning of the year weighted to be sure, but those flows did not unwind. We kept most of them. We kept about more than 3/4 of the flows into the fund last year. And then this year, we have been, for most of the year, floating around zero, net outflows, net inflows, on balance, slight net outflows, but nothing compared to what people would have expected. Why is this? It is because our strategy is a hedge, we believe, is highly differentiated, doesn't look like anything out there. So it is a diversifier, and it is a hedge against the disruptive innovation that we believe is going to disrupt the traditional world order, which is represented by the traditional benchmarks. Most of our stocks are not in the broad-based benchmarks. We have Tesla and a small bit of NVIDIA, but most of our stocks are not in the broad-based benchmarks, and they are all about the future and disrupting the way the world is going to work. So if for no other reason, people who want a hedge against that disruption, say they have a lot of passive exposure, a lot of benchmark sensitive exposure, they want a hedge against the disruption. We are a good hedge. As you say, I mean, most of my assets, certainly because of my company, but even apart from that, my financial portfolios are in ARX funds.
Your personal one.
Personal, are in ARX funds and crypto and private innovation funds. Why? Because we're doing the kind of research which is informing this judgment call. Wow, the world is going to change so radically during the next 5 to 10 years that I want to be on the right side of change now. And I know during a risk-off period, what happens? What happens is, because our stocks are not in the broad-based benchmarks, and because most portfolio managers and analysts try to diversify their portfolios to get closer to their benchmarks, they're selling our stocks and buying benchmark stocks. If we're right, and those stocks, and we see the FANGs already starting to show us that we are right, if we're right, then the traditional world order, is going to be disrupted, and these benchmarks and passive strategies are going to underperform our strategies going forward. We truly believe that. And just if I can double click on that, because you mentioned this a few times, the phrase "if we are right." Yes. You're very open and public about your research. Is there a probability in your models of how likely do you think that you guys will be right? Yes, every model that we do has a bull case, a bear case, and a base case. So yes, we do say, oh, what could go wrong? And I can tell you right now that I have never seen in my career the 5-year rate of return expectation that we have in our portfolios right now. So much so that even the bear case meets our minimum hurdle rate of return, So a compound growth over a 5-year period, so per year averaging 15%. Our bear case meets that minimum hurdle rate of return.
But I guess the scenario that you described in terms of the interest rates are going to go down, inflation's going down, your strategy is going to show that it's performing well again. What likelihood, if you could give us a number, do you ascribe to that?
Well, I usually like to stick to the data, and the data that we are seeing come along now, some of which I mentioned to you, is pointing very directly to deflation. I mean, many people, I do think that oil prices are still sky high. Gasoline prices might be because, the gasoline stations are taking more margin perhaps, but the oil prices have come down from 130 to 77 on the WTI, West Texas Intermediate. So, that was a leading indicator, oil prices, as were used car prices. Here in the United States, no one wanted to take mass transit during COVID. So used car prices on a year-over-year basis at their peak were up 55% year-over-year. Right now, they're down 13% on a year-over-year basis. So what the Fed is doing is using lagging indicators in making policy, which I think is very dangerous. They are using the CPI and employment. Both of those are lagging indicators. So I'm looking at the leading indicators, and they're pointing in that direction. So I'm feeling better based on data. I don't feel good that the Fed is looking at lagging indicators. And actually, I have written an open letter to the Fed, basically asking the question, how can you be making this policy unanimously, all 12 of you, when all of this conflicting data is coming through the pipeline? How come? And even the bond market itself is disagreeing with you. We have right now an inverted yield curve. What that means is long-term interest rates are lower than short-term interest rates. Now, if you look at it, the 2-year yield relative to the 10-year yield, 10-year yields are 75 basis points below the 2-year yields. What has this meant historically? First of all, it has never happened since the 80s. It never got this bad even in 08, 09. It means that either this is an and or. We're facing recession, which we believe we are. We're in one. Or inflation is going to surprise on the low side of expectations, or both. And we think it is both. And I think what's provocative about this time is I use the comparison to the early 80s. We have not seen a 75 basis point inversion in the yield curve since the early 80s. What's the difference between now and then? The difference is 75 basis points compared to 3.75% 10-year bond yield. That's 20%, 75 basis points on 3.75. If you do 75 basis points on 15%, which is where interest rates were then, that's 5%. The inversion is much more significant today. And so that's the bond market saying, hello, Fed, are you watching? And there is one other time period I'd like to use as an analogy. Many people do not look back before World War II because the economic statistics proliferated after World War II. And they were all based on the industrial world, the Industrial Revolution, and so forth. If you go back to the late 19 teens, the period was very similar to the period we're in today. There was a war. It was World War I. There was a pandemic. It was the Spanish flu. It was the most prolific period for innovation in history. 3 platforms evolving at the same time: telephone, electricity, and the automobile. Those were technologically enabled innovations. And so a very similar environment to today. Now, of course, the war back then and the famine, much worse. But there are echoes of this today. What happened back then? Major supply chain problems, right? Inflation got up to 24% in June of 1920. But as the war was unwinding, or we had adjusted to it in this case, working around it, and the Spanish flu was ebbing, inflation went from 24% in June of 1920 to minus 15% in June of 21. Now, I don't think we're going to minus 15%, but I do think we're going to be surprised magnificently on the low side of inflation expectations.
Just before we move on to another topic, so one piece of the question was if you had to go back and you had the benefit of hindsight vision, was there anything where you would say you made a mistake or any regrets, or would you say nope, I'm 100% happy with the way that we approached the last 18 months?
Yes. So when investors buy our portfolios, our strategies, they know what they're getting. This is pure play innovation, truly disruptive innovation that they are not accessing through other strategies, especially the passive ones. Now, what percentage they choose to put in our strategy, and if there are advisors involved, know your client. How much risk are they willing to take? What the advisors that we're working with during the last year, many of them have rebalanced toward our strategy. So they have 5% of their clients' assets in our strategy, and they have much more in other strategies and bonds and so forth. And because our strategy has gone down so much, to rebalance, they've had to, and just get back to where they were. They buy, more, I think, than people would expect. And I think what they are expecting, so in averaging down, their average cost has come down. And if we outperform the way we and they expect, they will get back to those averages and way beyond over time. We're a long-term innovation strategy, and that is how they're treating us. There are investors who put, a great deal of their wealth into strategies like ours. I mean, I did, and I don't regret it, because our conviction in our research and in the outcome here is so high. So I don't regret it. Okay. But I am sure that others do. And so this is a great time to say diversification is your friend at all times. Average down into those strategies you really believe in. If you believe the future is going to treat innovation very well, as we do, because there has never been more innovation going on than there is now, then average into our strategies. What we find, and what we say all the time, is for the most part, the portfolios that we see, advisor portfolios, they have maybe 1 to 5% in our strategies. In our view, they are short innovation, even with that percentage. Given what we expect, so we expect truly disruptive innovation to scale from $7 trillion in market cap globally in the equity market today to $210 trillion by 2030. That's a 30-fold increase. Now, we could be wrong, but if anything, that number has grown and continues to grow because of breakthroughs in artificial intelligence. What that will mean is truly disruptive innovation will go from less than 10% of the global equity market now to more than 50% in 2030. Most portfolios are not set up for that. They own very little of what we are doing. And if they want to catch the wave, they are either averaging down or initiating positions. Now, consider the source. Of course, I would say that. I started this company out of the belief that most portfolios are short, truly disruptive innovation. And if anything, this risk-off period has exacerbated that fact. Yeah. And so do we apologize? we are so sorry when people lose, money in our strategies, especially if it is in retirement accounts and they're getting close to retirement, of course. And so it just goes to reemphasize the point. You really do need to be exposed to our strategies, but only as much as you feel you can take the risk, because our strategies are volatile. But what does volatility mean? We've just been through the downside of volatility, and volatility has become a bad word. Volatility on the upside is beautiful. And, having been through such a performance down round right now, the odds have to have risen that the market will start rewarding truly disruptive innovation once again, especially if inflation and interest rates come down.
Speaking of innovation, speaking of 2030, you made the forecast that by 2030, Bitcoin will hit $1 million. Meanwhile, you have folks like Warren Buffett, Charlie Munger saying they do not see any kind of value in Bitcoin and stay as far away as possible from it. If you were to speak to Warren Buffett and Charlie Munger, how would you convince them that A, they're wrong, and B, how did you come up with the number 1 million? If you can walk us through the research and the math behind that.
So what I would say is, we are doing different things. Their investment style is much more value oriented, cash flow driven, dividend driven, and brand driven, I would say. And there is a place for that, of course. Mm-hmm. We're not doing that. We are focused on truly disruptive, transformative innovation. Our research team is set up in a way very different from traditional asset management, which I would characterize Warren Buffett and team. Mm-hmm. Our analysts' responsibilities are broken out not by sector, not by industry, not by sub-industry. They are broken out by technology. Mm-hmm. So there are 5 major innovation platforms evolving right now, involving 14 different technologies. So our analysts are technology specialists and sector generalists, because we expect these technologies to scale into mass market opportunities. Mm-hmm. So that's how we've set ourselves up. In terms of Bitcoin itself,
and I would love to, because I think the way that you approach research in a very transparent way is very interesting. So maybe for 30 to 60 seconds, if you don't mind, could you just run us through? So within your research team, how did they come up with the number of 1 million by 2030? How did the research process work? Just talk us through how the inside of ARC operates to give our listeners and viewers a better feel for how you come up with the research, how you come up with the forecasts, because I do think it's a very unique approach to publishing it like that.
Sure. So our starting point is from the top down. Mm-hmm. We are as bottom-up stock research driven as any other team out there. Mm-hmm. Our investment time horizon is 5 years. Mm-hmm. And as I mentioned before, we have both top-down, bottom-up research and the scoring overlay. So so the top-down is really what you're asking about now. Sizing this opportunity. How big is this going to be? Well, one of the first places we started was the remittance market. The remittance market, you'll have individuals, let's say from India, working in the United States, and they're remitting money back to their families as they do. And they're paying a toll taker. Often it can be 8%, but if you look at Nigeria, for example, it can go up to 25% or more. That is a terrible tax. Mm-hmm. If Bitcoin were the remittance mechanism, the cost would be de minimis, and the speed would be instant, right? Almost instant. So we sized that market. How big is the remittance market? It's $700 billion. They should go to Bitcoin. It absolutely should go to Bitcoin. Bitcoin is the most secure network in the world. And we believe that's the technology. And even after this latest crisis with FTX and the fraud, if you look at the hash rate of the Bitcoin network, it is at an all-time high. And that is how you measure the security of the network. The problem with FTX is it was a centralized entity run by effectively one person. That is the antithesis of Bitcoin and really crypto. Agreed. We're talking about decentralization, transparency. You've got it in Bitcoin. No throat to choke. So it's the first global, think about that, very big idea. Private, no government oversight, no throat to choke, automatic, right? Technology driven, digital, rules-based monetary system. This is a very big idea. 21 million units is as far as this is going. And we're at roughly 19 million Bitcoin right now. So scarcity factor is what is going to be at work here. And we believe that if you go into our Big Ideas 2021, you'll see the building blocks of the $1 million forecast. And so it starts with remittances. Substitute for gold is another one. Insurance policy against the confiscation of wealth. How does confiscation of wealth happen? It happens through inflation. And it happens through outright confiscation. I am sure that the relatives of MBS in Saudi Arabia, his cousins, did not expect him to extract their wealth, just take it away from them. And when they were at the Ritz Hotel, right? Wouldn't it have been nice to have a private key and then go over a border and reclaim or claim some of that wealth? So we think all individuals with wealthy individuals, will use something like Bitcoin being the most secure, as an insurance policy against the catastrophic loss of wealth. But if you look at the building
sort of like
blocks,
people having gold bars at home.
Exactly, which is part of the gold substitution. So you'll see the building blocks. We lay them out. The institutionalization, when we saw Mass Mutual put 100, which is one of the most conservative insurance companies in the United States, put $100 million of Bitcoin into its general account, we said, whoa, this is, think about all the regulatory hurdles it had to overcome. So we do think institutions are going to, that we may have set that back with the FTX until everybody sees the dust settle and really understands that that was a problem of centralization and fraud. But if you look at the underlying network, it didn't skip a beat. A hash rate at an all-time high, security never higher, and there are some meaningful use cases which will take it, we believe, to $1 million plus by the year 2030.
I'm afraid we've run out of time. One final question. We talked, or you touched on Meta. Do you believe in the metaverse?
Yes, it's an interesting question. We do, but you're going to be maybe a little surprised at our foray and your foray, given what's going on here, into the metaverse. You and I are in the metaverse right now. When you think about it, Zoom introduced us to this idea of the metaverse. Before we'd be on the other end of a telephone line, and I wouldn't be able to see your expressions and wouldn't be able to read into some of the other things you're really thinking, right? So this is a very early form of it. In terms of the friction associated with the metaverse, as Mark Zuckerberg is building it, the goggles or headsets, I think that's, it's a bridge too far, and it's much too much friction to have a completely immersive environment happen today. There are still some technology hurdles as well associated with, comfort and lack of nausea and all of that. But we do believe, what we do believe is that the metaverse is going to feature property rights for the first time in the digital realm. And the first manifestation of that was NFTs. But just think about it. You saw how I described Bitcoin as the first. Well, what are NFTs? Or they're a manifestation of the first global, again, going global right away, not just one country, global, immutable. They're still working on that one. We got to get away from depending on legal systems, because then you're dependent on governments and all of that. But immutable, digital property rights. And that's very provocative to me with a background in economics, because what is the best way to pull people and countries out of poverty? It is property rights. And digital property rights, if done right, we think will do just that. So we're pretty excited about the metaverse, certainly conceptually,
just not
but
Zuck's
also
smart metaverse. Yeah.
Exactly. Okay. I think he was trying to force fit it before its time, and I think the stock is speaking loudly and clearly. One thing I will say about his business is, in his last quarter, I was shocked to see how strong engagement on the various Facebook properties is. I mean, it's still a juggernaut, but I think this $10 billion allocated to the metaverse over the next year, I think the misallocation of resources is what the stock has been responding to.
Fantastic. Thanks so much for your time and for sharing your thoughts with us, Cathie.
You're
I really
welcome,
appreciate
Max.
it. There's a lot more I wish we could have covered, but perhaps we can do a follow-up sometime. And
That
to all
would
of
be great.
our listeners and viewers out there, if you are new to Finimize, make sure to subscribe to our newsletter on finimize.com. It's completely free, read by 1 million people. Download our apps in the Google and Apple App Store. Thanks again to Cathie for joining us, and we hope you enjoyed the session, and see you next time. Bye-bye.